What happens if I go over the IRA income limit? Have you ever wondered what happens if you exceed the income limits for your individual retirement account? Understanding the rules around IRA income limits is essential for effective retirement planning. Let's break this down in a straightforward way. First, let's clarify what IRA income limits are. For Roth individual retirement accounts, the Internal Revenue Service sets specific income thresholds. These thresholds determine how much you can contribute based on your modified adjusted gross income. For the year 2025, if you are a single filer with a modified adjusted gross income under $150,000, you can make a full contribution to your Roth individual retirement account. However, if your modified adjusted gross income falls between $150,000 and $165,000, you can only make a partial contribution. If your modified adjusted gross income exceeds $165,000, you cannot contribute directly to a Roth individual retirement account. For married couples filing jointly, the full contribution is allowed if your modified adjusted gross income is under $236,000. A partial contribution is available for modified adjusted gross income between $236,000 and $246,000. If your modified adjusted gross income exceeds $246,000, you cannot contribute to a Roth individual retirement account at all. Now, what about traditional individual retirement accounts? Unlike Roth individual retirement accounts, traditional individual retirement accounts do not have income limits for making contributions. You can contribute to a traditional individual retirement account as long as you have earned income, regardless of how much you earn. However, if you or your spouse is covered by a workplace retirement plan, your ability to deduct those contributions on your taxes may be limited based on your income. So, what happens if you accidentally contribute to a Roth individual retirement account when your income exceeds the limit? The Internal Revenue Service considers this an excess contribution. Excess contributions are subject to a 6% penalty tax each year until you correct the mistake. To avoid this penalty, you must withdraw the excess contribution and any earnings it generated before your tax filing deadline, including any extensions. If you find yourself over the Roth individual retirement account income limit, you have a few options. One option is to recharacterize your Roth individual retirement account contribution as a traditional individual retirement account contribution before the tax deadline. This means your contribution will be treated as if it was made to a traditional individual retirement account instead. Another strategy is to use a backdoor Roth individual retirement account. This involves making a non-deductible contribution to a traditional individual retirement account and then converting it to a Roth individual retirement account. This method is allowed under current tax law and is commonly used by individuals who exceed the income limits. From a retirement planning perspective, it is wise to check your modified adjusted gross income each year before making contributions to your individual retirement accounts. If you are close to the limit, consider tracking your income throughout the year to avoid surprises. If you accidentally make an excess contribution, act quickly to correct it and avoid penalties. Going over the income limit for Roth individual retirement accounts can lead to penalties, but there are ways to fix the mistake and still save for retirement. Traditional individual retirement accounts do not have income limits for contributions, but your ability to deduct those contributions may be limited if you have a workplace retirement plan. Understanding these rules helps you make informed decisions and keep your retirement savings on track.